Morning, Bank of Canada Governor Poloz and Senior Deputy Governor Wilkins. They'll be here for 45 minutes, so we're finishing up at noon Eastern. We'll start with a statement by the Governor, and then we have some questions. Governor.
Well, thank you, David. Well, good morning, everybody. Senior Deputy Governor Wilkins and I are happy to be here to answer your questions about today's interest rate announcement and our monetary policy report. Let me elaborate on some selected issues that were central to the Governing Council's deliberations. The uncertainty that we face as forecasters and policymakers remains undiminished. The NPR outlines a number of risks to our projection in both directions. In our discussions, though, Governing Council was particularly concerned about the ramifications of U.S. trade policy because it is so fundamental to the Canadian economy. But we cannot capture these in our projections because they are simply unknown at this point. We considered the possibility of not incorporating any U.S. policy changes in our projection. However, Governing Council felt that some form of fiscal stimulus was likely over our projection horizon. Accordingly, we've made some reasonable initial assumptions about fiscal initiatives, specifically corporate and personal tax cuts that would raise the level of U.S. GDP by about 0.5% by 2018. This assumption could be recalibrated in either direction, but doing the work now provides a framework for analyzing the situation as it evolves, while also giving us a better balance of risks over the projection horizon. According to our analysis, a U.S. fiscal shock of this magnitude would probably have only small effects here in Canada, boosting GDP by about 0.1% by 2018. This is because there are three important offsets that would limit the transmission of such a shock to Canada. First of all, a corporate tax cut in the U.S. could adversely affect Canadian export competitiveness. This would mean lower exports and investment in Canada than otherwise. Although our Business Outlook survey shows a stronger investment intentions, some of this may be coming from firms with cross-border operations, considering new investments in the U.S. rather than here in Canada. Secondly, an important consequence of rising U.S. optimism has been an increase in U.S. bond yields, some two-thirds of which has been imported into Canada, much more than in many other countries. Now, while this reaction is consistent with past correlations, it is at odds with Canada's macroeconomic situation, where there is material excess capacity, unlike the U.S. economy. This divergence in economic performance is mainly due to the setback that Canada endured when oil prices collapsed. Canadian 5-year mortgage rates have already risen in response to higher bond yields, which will act as an additional drag on housing demand in Canada. Troisièmement, la valeur du dollar américain a augmenté par rapport à la plupart des autres monnaies. Comme le dollar canadien a réussi à se maintenir par rapport au dollar américain dans ce contexte, en raison surtout des prix du pétrole plus élevés, il s'est également apprécié comparativement à la plupart des autres monnaies. Cette combinaison crée deux vents contraires additionnels pour les exportations canadiennes. Des exportations américaines plus modestes vont se traduire par une demande plus faible de composantes canadiennes de ces exportations américaines. De plus, le Canada perdra davantage en compétitivité sur le marché américain comparativement aux exportateurs d'autres pays. En ce qui a trait à nos prévisions concernant les exportations, nous publions aujourd'hui deux nouveaux documents d'analyse du personnel sur la modélisation des exportations. Ces études font ressortir principalement la possibilité que notre modèle précédent ait donné trop de poids à l'évolution de l'économie américaine et pas assez à celle d'autres économies, aussi bien en termes de progression de la demande qu'en termes de mesure de la compétitivité. En fait, Les deux nouveaux modèles expliquent la majeure partie du manque à gagner sur le plan des exportations dont nous avons parlé, de l'ordre de 30 à 40 milliards de dollars, et prédisent une croissance future plus lente des exportations que notre modèle précédent. La projection que nous présentons aujourd'hui est semblable à celle d'octobre parce que nous testions déjà les nouveaux modèles à ce moment-là et que nous les avons utilisés pour formuler notre jugement. Cela dit, selon notre projection révisée pour l'économie canadienne, qui, je vous le rappelle, est plus conditionnelle qu'à l'habitude, notre économie affichera une croissance supérieure au potentiel au cours des prochains trimestres. Cette situation impliquerait une diminution constante des capacités excédentaires au Canada durant la période de projection. While some of the recent data have been encouraging, and I'm thinking here in particular of the latest data on exports, employment, and business sentiment in our BOSS, they do not support a forecast of above potential growth by themselves. Rather, that projection continues to rely on the expected effects of domestic fiscal stimulus. We've already seen some early effects from the Canada Child Benefit on household spending, and there have been some new measures introduced at the provincial level. But the main ingredient in our forecast is the federal infrastructure program, which is well underway but not yet evident in the economic indicators that we are tracking. In fairness, the best place to see this is in the national accounts data, which are so far available only through the third quarter of 2016. Now, all of this matters because persistent excess capacity puts downward pressure on inflation, raising the risk that we will continue to fall short of our inflation target. We've recently introduced 3 new measures of core inflation, each with its own strengths and weaknesses. Now, these are not target variables. Rather, they are analytical tools. They help us to see through shocks, give a better guide to what is happening to the underlying trend in inflation. And in particular, they are much more correlated with excess capacity than total inflation is, simply because total inflation is constantly being buffeted by temporary price disturbances. Our new measures of core inflation are all below 2% presently, weighed down by excess capacity in the economy. Now, in addition, food prices have been running below expectations in recent months, due in part to enhanced competition at the retail level. That's something that we will continue to monitor. But looking ahead, Governing Council expects inflation to move up to close to 2% in the near term, mainly because of firmer energy prices. And more importantly, our growth outlook would imply a narrowing of the economy's excess capacity over the course of 2017 and into 2018. So, in the absence of any new shocks, we would expect all inflation measures to converge sustainably on 2% in the latter part of our projection horizon. To conclude, in the context of a projection that is largely unchanged, the Bank's Governing Council judges that the current stance of monetary policy is still appropriate and maintains the target for the overnight rate at 0.5%. Governing Council will continue to assess the impact of ongoing developments, mindful of the significant uncertainties weighing on the outlook. I thank you for your attention, and now Senior Deputy Governor Wilkins and I would be happy to take your questions.
Thank you, Governor. When I call upon you, I invite you to ask a question and one follow-up, and as usual, gold stars will be awarded for brevity. Thank you. Andrea Hopkins, Reuters.
Yes, good morning, Governor, and thank you for taking our questions. I'm wondering if you can provide some color as to the discussions around the Governing Council. You've said previously you considered a rate cut. Is that still something that's considered or discussed? Was it? Conversely, was a rate hike discussed? Can you give me some color about your interest rate decisions and what was considered by the Council?
So, yes, thank you for that. Going back to October, which I think is the appropriate frame since that's our last set of projections, fundamentally, not much has changed since then. The forecast, as I've just said, is largely the same. We've had a few data points in between that were actually in line with our forecast and therefore have attracted more positive attention just because they weren't disappointing, as the data have tended to be in the last few quarters. But none of those data points constitute a trend in and of themselves. The really only big piece of news that's happened since October is the U.S. election. And so we took that on board and decided that we should incorporate some form of fiscal stimulus, since there seemed to be a fair bit of agreement around something. I don't know exactly what it's going to look like, but we've modeled it in a way which seems reasonable, at least to get us started on that discussion. And with that, we find when you look at the nuances of it, there's very small effect passing through to Canada. We have a backup in bond yields in the wake of the election, and that is affecting Canadian mortgage rates, 5-year mortgage rates, so far quite modest. And we have a stronger Canadian dollar measured in multilateral terms. But I think most importantly, what we have is heightened uncertainty about trade policies in particular. So with that package, we identify a number of downside risks as well as upside risks in our projection. But should any of those downside risks materialize and put our inflation target at risk, then we would have the room to maneuver. And so in the basic answer to your question, in that context, especially with inflation having been below target for a prolonged period, yes, a rate cut remains on the table. And it would remain on the table as long as those downside risks were still present. Well, I think that's the answer.
To your export, the additional work you've done on exports, how confident are you now that your forecasts can capture reality?
Well, I would say more confident than before, because the work that we've done has taught us some things. But no model is a guarantee. Maybe Carolyn would like to walk us through some of that.
Sure. Yeah. I mean, no model's perfect. I mean, what you can see from the papers that we published is that we've taken a number of different approaches that really try to better identify the sources of growth that we have for the exports that Canadian firms can offer the world, as well as how much of that demand we might actually achieve given our competitive position. And when you look into the details, you can see that a number of things that we hadn't taken into account properly before that we're now able to take into account. And one of them is just what parts of U.S. demand really benefit us. A little bit less on the investment side, both residential and business, a little bit more on their own exports because we have inputs to their exports, as well as government. I mean, another thing is the weight on the rest of the world just has to be a bit bigger in both our measures because we have adapted and we have broadened our sources of export partners. And so those things together, as well as some other attempts to take into account competitiveness, both by measuring an effective exchange rate, as well as another proxy for competitiveness, has really helped us improve our forecast performance, at least explain the history that we had. The Governor talked a lot about the missing exports, the 30 or 40 billion, and certainly we can explain a lot of that with this. Excuse me, I have to use my Kleenex. I've succumbed to the Ottawa winter. But and so I think we've come a long way. We've got a better base from which to start. That being said, it's not going to capture really big structural changes should they occur in the future, and that's why we also look at the data. We talk to firms, and we augment our pure model forecasting with actual conversations and with some judgment.
De le cœur, la presse.
Merci. Ma question est pour le gouverneur. La dernière enquête sur les perspectives des entreprises laissait entrevoir un certain optimisme pour l'investissement et pour l'embauche. Les perspectives venant des États-Unis vont peut-être neutraliser ça. Il reste qu'au 3e trimestre, il y a eu destruction d'entreprises au Canada et non pas création d'entreprises au Canada. Et il ne peut pas y avoir énormément de stimulus dans l'économie ou d'esprit animal, pour parler comme Keynes, s'il n'y a pas création d'entreprises. Comment on peut expliquer que même s'il y a eu énormément de croissance au 3e trimestre, il n'y ait pas création, mais destruction d'entreprises au Canada?
Bien, ces choses ne sont pas toujours parfaitement corrélées. Je pense que vous comprenez cela bien. Mais franchement, c'est une question de tendance. Et même si il y a une mesure d'optimisme en ce moment, c'est dans le contexte d'une incertitude plus grande qu'auparavant. Alors, c'est une situation pas habituelle. Nous avons plus d'incertitude et légèrement plus d'optimisme. Ce qu'on voit, c'est que l'optimisme, probablement, une source, c'est qu'on a vu probablement le creux de la situation dans le secteur d'énergie au Canada. Certainement, ces entreprises sont dans notre enquête et ils sont plus optimistes maintenant. Et ils recommencent, en effet, de dépenser de l'argent. Et deuxièmement, il y a des entreprises qui ont déjà des opérations qui traversent la frontière. Ils ont des opérations ici au Canada et aux États-Unis. Ils sont membres des équipes d'offres, en effet, les Global Supply Chains, chaînes de provisionnement. Et dans ce contexte-là, il y a une augmentation d'optimisme aux États-Unis. D'un certain extent, ça c'est partagé par nos entreprises. Mais pour l'investissement, ce n'est pas clair pour le moment où ils pensent à investir. C'est possible qu'ils pensent à investir aux États-Unis, dans leurs opérations aux États-Unis, dans un sens pour défendre contre les nouvelles actions potentiellement protectionnistes. Mais en ce moment, ce n'est pas clair vraiment. C'est juste un de nos indices, mais c'est légèrement encourageant sur balance, mais c'est dans le contexte qui le rend pas clair.
Et pourquoi il y aurait destruction d'entreprises?
Bien, c'est important de rappeler que nous sommes dans un ajustement très complexe. C'est un ajustement structurel de l'économie. Ce n'est pas fini. Ça a commencé il y a 2 ans. Et dans nos analyses en ce moment-là, on a parlé d'une période de 3 ou peut-être 4 ans d'ajustement. C'est une période d'ajustement au niveau plus bas du prix du pétrole et les autres changements au niveau global. Alors, il y a toujours la destruction des entreprises, toujours, et la création. Et c'est la situation nette qu'on s'intéresse. Mais c'est vrai qu'il n'y avait pas une grande résumption de croissance de la population des entreprises. On attend ça, mais ce n'est pas là jusqu'ici.
Michael Couture, Global News.
I hate to try and make it this simple, but I just wanted to ask you, Governor, was the bank on target to hike the interest rate but changed course because of what happened in the U.S. election? And how much of a factor was it really?
So was the bank on track to hike interest rates?
Yeah. I mean, you
No.
you said it was still on the table.
Well, I think if you're talking about Andrea's question, she was asking about a rate cut. Is that what you're asking me about?
No, I was asking about, was there, or let me put it this way. How much did the election change any decision to make a rate change?
So, as I indicated before, what it has done is, back in October, we identified a number of things which were raising uncertainty beyond the normal level of uncertainty we normally deal with. And so at that point, we decided, well, we did not have sufficient information to take further monetary action at that time, given those uncertainties. And I'm arguing that in the post-election period, uncertainty remains undiminished, and that's a conservative statement. On many fronts, arguably, it has increased. And so, in that context, with our projection, which of course sets aside much of that uncertainty, it simply can't deal with what possible changes in trade policies might occur. That is all set aside. So having that major assumption there, and another assumption which is for a fiscal package that we've modeled as described, those assumptions are to take us in a zone for forecasting where uncertainties are higher than normal still. And so, that's the context in which we would consider exactly the same situation, and we said the forecast really hasn't been changed much, and therefore our situation is about the same as it was in October.
Following up on that, if you could give advice to businesses in Canada and Canadians about whether or not Canada will be sideswiped by protectionist policies south of the border and trade, what would your advice be?
Well, unfortunately, that's too complicated a question, even though it sounds like a simple one. We simply don't know. Economists are fond of discussing free trade versus non-free trade. That's a very simple question, but that's not the kinds of question that we're faced with. What we're faced with is potentially changes to our trade infrastructure, our trade architecture, if you like, which have very complicated effects. When you change a trade policy, it affects people, both individuals and companies, on both sides of the border. They react differently. They may spend differently. They may invest differently. They may run their businesses differently. A company may adjust its profit margin, or it may invest more, or it may invest less. It's a very complex question. So we will have to wait and see what sort of specific changes may occur. We shouldn't analyze them by making them up. We have to analyze the ones that show up, at least on the discussion table.
Kim McRae, Wall Street Journal.
Thank you for taking the questions. You mentioned just now that Governing Council was particularly concerned about the ramifications of U.S. trade policy. Can you give a little bit more detail about those discussions and how you weighed the value of bringing in one part of the possible ramifications by talking about the impact of fiscal stimulus and not bringing in trade policy?
Yeah, it's a fair question. It's more a question of somewhere along the spectrum between not knowing anything and knowing something and knowing a bit more. And as well, on the fiscal front, there just seemed to be a little more uniformity of response, around Washington. It just suggested that it was more likely that in the near term some sort of an agreement would be reached on a fiscal package of some kind. And we don't pretend that this would be it. It's just meant to illustrate. And what I think it does is it allows you, therefore, to see that it's not just a simple case of if there's a fiscal shock, that'll boost growth, and that, of course, will boost growth in Canada. It isn't that simple. And so we lay out the analytical framework that we would be using, regardless of what fiscal changes may get presented. And so it's important to know that those other moving parts would matter to how the bottom line would look for Canada. And also, given that markets appear to have embraced at least that part, the fiscal part, it may have seemed a little odd for us to need to incorporate the market reaction in our forecast, but not the underlying shock that was causing the market reaction. So you could imagine if all you had was higher bond yields and a stronger U.S. dollar, therefore a stronger Canadian dollar, you'd have only negatives in the forecast and none of the positives that presumably are producing those things. So it makes it difficult to construct what we call a balanced risk forecast. So this is an attempt to do that, but on the trade side, we just didn't think we had, you know, anything concrete really to work with. And as I said, it's like changes in trade policies have more micro effects. Like they vary by sector, they vary by consumer versus businesses. They vary a lot, and then you have this multitude of adjustments. So they'll require careful analysis of more specific things before we'd be able to translate them into a more simple macro depiction, which is simply not able to do that yet.
And just to follow up on that, when you say you work to present a balanced view of the risks on fiscal policy, did you consider in your discussions that there might be a risk of you come up with a 0.01% increase for the next 2 years, I think, for Canada? Yeah. By dealing with fiscal policy only and not dealing with the trade policy side of things, that there's a presentation of an upside risk and perhaps not a downside risk in terms of trade policy.
Understood. So we have several risks at the back of the NPR, which is meant to capture all those things. And so, you know, some things we can bring up into the analysis, which is what we tried to do here. And I'm just saying that there seemed to be enough agreement around Washington that something like that would come. So therefore, a forecast that didn't have it would seem unbalanced. But you know, it could have been in the risk. And we actually, as I mentioned in my opening statement, we discussed at length whether we should bring it in or keep it as a risk. We just decided that this was more appropriate, and it had the extra advantage that we could demonstrate clearly to folks, you know, what would be the chain of influence through Canada, you know, in fairly detailed way. And obviously in that modeling, there are trade effects, you know, captured in that. And so, Carolyn, perhaps you'd like to add something on that.
Yeah, I think you cast it really well. The only thing I would add is that even in what we assumed as an initial assumption for the fiscal policy in the U.S., it just takes into account some changes in corporate tax policies and personal tax policies that were in the House Republican tax reform plan. It does not include many of the other types of fiscal policies that have been discussed in the same way that trade policies have been discussed. And so it's possible, when you think of it in a balanced sense, it's possible that fiscal policy, even with the corporate tax, could be less than we think. It's also possible that it will be accompanied by other fiscal actions that will make it more. So in that sense as well, it seemed to be quite a sensible assumption to make.
Kevin Carmichael, Canadian Business.
The NPR presents the value of the Canadian dollar as something of a headwind. Is the central bank surprised by the strength of the currency? And could you elaborate on the reasons that its value is moved the way that perhaps you expected?
Well, in our projection, we simply take the average of recent data points and hold it unchanged for our forecast. The discussion that we've mentioned in both the press release and the opening statement is around the Canadian dollar value against other currencies. So in effect, we all know the U.S. dollar has risen in this context. That started before the election. It's been rising for a while. And in that context, for the most part, the Canadian dollar has gone for that ride by kind of holding its level more or less unchanged against the U.S. And so what we're pointing out here is that we must remain mindful that those competitiveness effects matter too. It's not just a bilateral relationship that matters. That in fact, when a company in Canada is competing for a contract, a sale in the United States as an exporter, they're competing with exporters from other countries whose currencies may have been falling relative to the U.S. while we've been holding steady. Mexico being a classic example, but many others. Carolyn, do you want to go into how we've adapted our model to capture this.
Yeah, I mean, there's many ways to estimate an effective exchange rate, and so we've done it a number of different ways over time. But the enhancement that we've made more recently is to weight the Canadian dollar against our largest trading partners, but a wider range than we did before. So it's about 16, and we try to take into account not only export relationships but import relationships. And so what that does, and it's important to know this, is it reduces the weight that we used to have on the U.S. dollar from, it was about 75% or something like that, to about 50%, and it raises the weight of other countries like China, for example, which used to be 3, now it's a little bit over 10, and so, and Mexico as well. And so when you think about, and that's the exchange rate that works a lot better in our export equations as well. So, and when you look at that, I mean, we were talking about since the last MPR in October against the peso, we've appreciated a little bit over 10 since the beginning of 2016. So it's about 33%. So these movements can be quite large in other currencies.
And to reiterate the second part of that original question, do you have a house view on why the Canadian dollar is remaining elevated against currencies other than the U.S.? So someone might be surprised by that. It seems that perhaps it should be weaker along with lots of others.
Well, I mean, I think historically this is not uncommon. When the U.S. dollar is moving significantly relative to most other currencies, there's a tendency in markets to sort of see whatever the good news that's affecting the U.S. must be affecting Canada too. And so historically the correlation has been there. And unfortunately, what's happened in the last 2 to 3 years is we've had the terms of trade shock that we've discussed so extensively here. The fall in oil prices, which has been, that's a shock, which is net a positive for the U.S. economy and a very significant negative for the Canadian economy. And so that was, for Canada, a very important setback in this process of getting back to full capacity, at least a 2-year setback. And so in that context, we have a reduced correlation between Canada and the U.S., and this is why a year ago I was giving speeches entitled Policy Divergence. It's because we could see that this would come, that the U.S. would get to a place where they're pretty well at full capacity quite a lot before Canada would. So we want to make sure that we all understand that Canada has quite a bit of excess capacity, room to grow for some time yet before reaching that stage, and so that correlation shouldn't be as high as it has been. So in that context, of course, it therefore results in a headwind for export performance because you don't have the positive growth underneath it, you know, to match it.
Raoul V. Epoch Times.
Thank you. Just about the labor market, given the overall projections are largely the same as October. Do you see any improvement there? Like, is it participating at all in the above potential growth as we see this year? And just kind of as we go into seeing the output cap close in mid-2018, do you have like any ideas or projections of where unemployment and wage growth should be by then?
Sure. Why don't you?
Yeah, okay.
And I'll follow up.
Well, I think you mentioned, Governor, the labor markets being one of the sort of brighter spots in the sense that I guess over the last 6 months, employment growth's been above trend, about 28K per month, which is above trend, and so you know you can't see that as bad news. When you dig into the details, though, and you think, well, what does that mean about capacity? Well, you can look at the types of jobs that are being created, they're part-time, and so not many hours, not a lot of growth in hours. It's been pretty flat, even falling more recently, and you know. Along with that, you see wage growth hasn't been that strong either, about 1.7. And so of course, when you take that into account and you look at other factors like part rate, where is it relative where it should be prior to the crisis? Long-term unemployment, is it still higher than it was prior to the crisis? they're all still pretty high. And so even though the unemployment rate's about 6.9, when you adjust it for those other kind of factors, it's about 7.5. Our labor market indicator shows about 7.5. So there's a lot of slack left. And of course, as the economy improves, the labor market should improve along with it, and so that should come down. I'm not going to give you a number of exactly where the terminal point for the unemployment rate would be, but what you would hope to see is job growth across the country in a wider range of industries with more hours, and certainly some people coming back into the labor force who may be discouraged, and those who are working part-time getting full-time jobs. And with that, some stronger wage growth.
Greg Quinn, Bloomberg. Good morning. I'd like to go back to an earlier question about the active consideration of a rate cut in October. Given that the economic projection hasn't changed that much since then, and there is more uncertainty after the U.S. election, I'm wondering why that statement about an active consideration of a rate cut wasn't in your opening statement today. Is it a change in communications, or is it a change in something fundamental to the economy?
No, I'd say none of the above. It's just just the fact is that when we came to discuss things, we found ourselves largely in the same policy space as we were, and I would say, though, along the way, we've had a handful of data points that were at least encouraging. Okay, and as I said before, they weren't encouraging in the sense of big positive surprises. They were just encouraging because they were in line with our view, and having lived with a number of data points that fell below our view for a while, that was reassuring. So when you get that sense of reassurance, there's no question it kind of changes the tone a little bit. But we're still at the point where we getting to where we'll have inflation sustainably on target is going to take about as long as we thought back in October, till around the middle of 2018, and the question marks kind of got bigger. So until we have actual downside risks, which are question marks, being actually realized, right, and causing us to doubt whether we can get to that sustainable point, in that reasonable time frame, then it's appropriate to reach a conclusion it's not time to try to add more stimulus to try to speed it up or offset a new shock. So as it is, we're still in that same ballpark. So there was no compelling need to, I don't know, to mention or not mention it. Just I'm not surprised to hear you ask. I guess that's so fine. We were quite open about it. We're in that ballpark where it would be nice if this thing went a little faster, but there are things that are coming. In particular, the infrastructure program, which is well underway, should begin showing up in the data, and that'll be another key piece of reassurance as we go along.
Secondly, in terms of having room to maneuver and big shocks that could hit the economy, is it fair to say that on the downside, things like reopening NAFTA or a border tax could be the kind of big shock like the oil slump that might lead to a rate cut? And on the plus side, if there is massive fiscal stimulus in the U.S., is that the kind of shock that would be big enough to lead to perhaps a change of risks in monetary policy to the upside?
Well, those are the things that we mentioned in the risk section, and so certainly, as I said before, if we have a predictable and open trade system versus something else, there's a natural tendency to think of that as a negative for a trade-dependent nation like Canada. But I want to emphasize that it is a very complicated question. As I said before, the adjustments are multiple. And so in a world which is complex like that, when trade rules are changing in various places, there can be trade diversion effects that are quite unexpected. So you really have to think carefully about of an individual initiative or proposal and ask, well, what are the multiple effects that this thing could have? And so we're not going to preempt all that discussion and so on. We'll do the analysis when we know more. But of course, in a broad sense, as we do in the risk section, you know, putting the trade architecture, you know, at risk for a trade-dependent nation like Canada, it's gotten, you know, the potential to be a negative shock. And the fiscal has the potential to be a positive shock. And as we illustrate here, which is not what you would call a huge fiscal shock, but one that's you know, a reasonable illustration, let's say, of how the effects would be. 0.5% on the U.S., well, you know, your immediate reaction might have been, well, we'll get almost all of that, you know, there'll be a lot more exports. And the answer is, well, there should be more exports, but there are also offsets, potentially, depending on what form that fiscal action took. In this case, a corporate tax cut has a competitiveness implication, which can change the trade picture by itself, and also the interest rate and exchange rate parts we talked about before. So there are offsets that we need to take into account. So yeah, it is positive in this analysis. I mean, it's responsible for bumping up our projected profile for Canada by, you know, 0.1 or so. It's not a lot, but it's visible. Anyway, so theoretically, you're absolutely right, but quantitatively is what matters. We can't formulate policy based on something that's positive or negative. We have to know how big, to know where it sits in our risk management zone, how far does it throw off our projected path for the inflation, because that's how we sum up what those risks do. If inflation is going to take an extra year to get to a sustainable point, that would be a very meaningful shock for us. That would be the sort of shock that would, like the oil price shock, you know, was more than a year delay, I think, as I remember it, was a very, very substantial revision to the outlook. So, okay.
Andy Blatcher, the Canadian Press.
Andy.
Thank you. Has the bank drawn up internal assessments of the possible impact of the different tax and tariff ideas being floated in the U.S. and what are the reasonable worst-case scenario for Canada?
At this time, we haven't, Andy. We just don't have enough concrete around that. We've got enough work to do our forecast and so on. But needless to say, we're on top of this in the sense of we've got our tools there. As soon as we have a little more understanding of what might be coming, then we'd be considering using our models what those shocks might mean. But I just again want to emphasize again that it's simply not a cut and dried, easy thing to do. It will be a lot of moving parts when these things start to get discussed, and therefore translating it into a macro context won't be easy. It's more like how it shades your risks, and then you have to watch and see how the economy responds, how businesses respond, and you watch the data, and your picture comes more into focus with that upfront analysis as your guide. Much like what we've done here for the fiscal, we've laid out the various elements that we would need to watch as we went along. Some of them might happen and some of them might not happen. So you keep monitoring each of those things as you go through.
Would you elaborate a little bit on the line that says material consequences for trade and investment for Canada if some of these trade policies are in fact implemented?
Yeah, well, as I said, there's a pretty basic presumption among economists that international trade is a positive sum game. And that is to say, it is not a zero-sum game. It is a positive sum game. So by trading, we generate more income on both sides of the exchange. That's what trade does. Now, the corollary to that is that pulling back trade is a negative sum game. That means that if you have less trade because of restrictive practices, you reduce income, and not just on one side of the border. You reduce it in lots of places. So that's a presumption that I think all economists carry: trade versus no trade. And so if you're going to contemplate a shock that would significantly change the rule book or the framework within which Canadian companies operate, there's a presumption that it would be a negative effect on Canada. But as I said, that's just your first starting point. When you get the specific nature of how the change looks, and whether it's a across-the-board type of thing or a targeted type of thing, all those considerations would change your analysis and the tools you need to use to try and figure out how it would look. And so again, several times this morning I've tried to emphasize how complex a question this is from a macroeconomic point of view. So in the risks section, of course, we think of it as a potential downside risk to the outlook, disrupting trade in some form. But until we know specifically what might be presented, we can't assess the magnitude. And I said material because, well, material means it's an important risk. It's not some risk that we would take lightly. But we would need to know and understand what we're dealing with to try and get a measure of it, and use a variety of tools to figure out how the dynamic consequences will look like. In a way, a lot in parallel with the terms of trade shock. Like when the price of oil dropped precipitously, well, there was a genuine debate in the profession about, was that going to be a significant negative or positive? And the fact is that we had the right model at the time, the totem, to actually understand it well. So we were able to put some clarity on that, and that served us pretty well, allowed us to respond quite early in the process and cushion the blow, et cetera. So that kind of modeling gives you the confidence you understand what the multiple effects will be and how they'll sort themselves out. And the same thing would be for trade. It would be a complicated analysis and more than one thing moving afterwards, complicated story to tell, and things to monitor as we go through.
It being 12:03, thank you very much, Governor and Senior Deputy Governor, for your time today.
It's a pleasure. Thank you very much,
See you in a couple
everybody.
of months.